Hey guys, welcome to this Ready Set Crypto video. And today we're going to explore how to respond to market downturns like what we're seeing today. First, we're going to talk about what people often get wrong about predicting the future, without really going into the merits of crypto itself, but why time and time again people are late to the party because they are terrible at predicting the future. Then we'll switch gears and talk about why people are bad at responding to a bear market. Through exploring both of these topics, we'll get a better understanding of how to respond rationally to a deflated sense of enthusiasm or belief in the market and the future of crypto, and how you can capitalize on that for personal gains. Okay, so as we mentioned, let's first talk about predicting the future in an educated sense and how most people are so bad at doing it. The first reason people get the future of crypto and so many other things so wrong is because they dedicate about 5 minutes to looking at something before they form an opinion on it. But that's not thinking. That's our monkey brain running a psychological heuristic that it's completely unequipped for. It's the part of our brain called the hypothalamus. It plays a major role in the basic biological drives related to survival, including the so-called 4 F's: fighting, fleeing, feeding, and mating. It's not competent at understanding anything new and novel. We have to constantly train it. It's a survival machine. Think about how people responded to the first cars. Oh, what's that machine? I don't trust that. Look how it spews black smoke everywhere. It hardly moves fast. It gets stuck in the mud. Why would I ever get rid of my trusty horse? So that's a nice transition into the second major reason people get the future so wrong is it goes against everything they understand about the world. Think about the fates of companies like Sears and Blockbuster. They mistook the past for the future, and they paid a heavy price by losing their illustrious throne as the market roared past them. Paradigm shifts and disruption define humans and our past. To see the future, you need to be able to step outside yourself, forget about your past successes, and see beyond your current understanding. Similar to discussing why Sears and Blockbuster failed, a third major reason people fail to see the future of crypto is because it challenges their position of power. That's why Chase CEO Jamie Dimon and many other bankers all declare Bitcoin and cryptocurrencies as a fraud or a scam. The powerful stay powerful by quashing anything that stands to challenge them. And there are a few institutions as powerful as the banking and finance industries, which is why they're hellbent on getting on major news networks every day and casting doubt on the potential of cryptocurrencies, until of course they come out with their own versions. The fourth major reason people fail to see the potential is because they mistake their opinion for reality. Simply because you believe something to be true doesn't mean that it is. I am fully aware that simply because I believe in the future of cryptocurrencies and their potential does not mean it's guaranteed to become reality. But I am willing to admit that to myself and to you. And most people can't do that. Most people cannot admit they could be wrong about something. This absolutely goes back to our biology. Another thing people are bound by their biology and thus get wrong about the future is a complete and total lack of patience. Waiting is the hardest part. It takes patience to let things develop naturally. Bitcoin has been around for almost a decade now. Critics like to point out that in that time, Bitcoin and blockchain have yet to solve anything of value. They are impatient combined with some of the other reasons we've listed. Innovations require mishaps and disappointments and tenacity. When you open your plan to the harshness of reality, things tend to break apart. Truth and time are whetstones that sharpen your ideas. For example, the TCP/IP protocol was developed in the 70s, but the internet did not enter most people's homes until several decades afterwards. Things take time. And so the last reason people are blind to the future of crypto is they take current inventions, carry them forward, and imagine them as the solution to future problems. But that's completely wrong. Current inventions solve current problems. Future problems will take future solutions. The steering wheel wasn't invented until 8 years after the first car. The screwdriver wasn't invented until 3 centuries after the screw. The can opener was invented 45 years after the can. It's nearly impossible to know what form those future solutions will take, but we can do our best to figure out what traits the solution will have so that we can recognize it when it gets here. And so this gets us to the next section of our video, called How to Not Be Dumb When the Market Goes Down, where for those willing to invest in cryptocurrency, the market can bring disillusionment and the disbelief in the future of crypto. Quite simply, there's a lot of people who invest in crypto because they believe it will always go up. And at first, they might be willing to believe in, hodling, but quickly realize that they bought in at the high and are now down 50%, and they turn into a weak hand and sell. Smart investors don't try to avoid a downturn. They make sure that they're in a good place when the markets go back up, because that's inevitable too. It's ironic to me that people will lose more in cryptocurrency because they panic than they have stolen from them. Storing your crypto off exchanges is a twofold security, because it protects you from those who would steal from you, but it also protects you from yourself, because you're less inclined to sell if you have to go through the pain of moving your money to an exchange. It causes you to have to think about your decision. So our rule is, do not panic unless you like losing money. Don't believe us? Even though crypto doesn't have a lot of history, we know that from the stock market that the guy who lost his password to his brokerage account would have done a lot better than the guy who constantly panic sells, by a lot. And so this is what it comes down to. You couldn't take the pain of watching the market run away, and now you can't take the pain of holding, and you will pay the price for not keeping your emotions in check. This is known as the paradox of trading. The best trades feel the worst, and the worst trades feel the best. So what we focus on this channel is how to go against the herd mentality. We're all pack animals, and we like to have assurance, and we want to be assured what we're doing is correct. That's known as confirmation bias. You're only going to listen to people who have an opinion you like, who align with your paradigm. And so this brings us to our second rule about how to not be dumb. You're not trading against the market, you're trading against yourself. This is absolutely true. The market is trying to give you information. It's trying to tell you exactly what you need to know in that minute, but you can't see it because you're trying to see it through your own lens of confirmation. And that's why you're trading against yourself. Quite simply, markets operate through pain. It's proven that the pain of watching the market leave the station without you is worse than the pain of taking the loss. So why are you fighting the market? Why are you blaming the market for your losses? Oftentimes, people who are acting irrationally find that they've put too much in and they've broken the golden rule of risk management. Only put in what you're willing to lose. Otherwise, you will be constantly on Blockfolio at 4 a.m. in the morning. If you're a new investor, automatic deposits are doubly important. Here's the thing about starting to invest. New investors tend to be way more emotional than old hands, which means that when the market goes down, they tend to panic. Panicking is bad, that much we've established. So if new investors can take the decision making out of the process, should I put more money in? Should I take more money out? And just keep it to small, regular deposits, regardless of what the market is doing, it's a great help in writing out those short-term gyrations in the market. And so that's the fourth and final rule. Do not try to time the market. Do not try to time the market. Everyone knows the goal of investing is to buy low and sell high. So you're thinking to yourself, if the market's bound to go down sooner rather than later, why not liquidate my investments? And after the inevitable downturn happens, snap up those bargain price cryptos. You might be smart, but no offense, you're probably not smart enough to perfectly time the market. Why? Because unless you're a robot and you're constantly plugged into everything going on in the crypto markets, smart investors just stay the course and stay invested despite any market fluctuations. Research shows that trying to time the market more often than not leads to worse returns. The steady as she goes investment strategy beats pretty much everything else unless you're lucky or very talented. So guys, thank you very much for watching. If you enjoyed the video, please hit the like button. And if you're new here, please hit that subscribe button so you can continue to see high quality crypto analysis. And don't forget to hit the bell next to the subscribe button to be notified when we put out new videos. Additionally, check out the description for a link to our daily newsletter. Thanks again for watching, guys. I'll catch you in the next one. Cheers.